pull up a chair. Let's have a real, frank conversation in this explainer today. If you're watching this, you're obviously looking for the truth about why you are still struggling to find consistency in the markets. So today, I want to step into the role of a veteran mentor for you. We're going to completely break down the exact psychological hurdles and tactical missteps that are keeping you stuck, and we're going to do it by finding total clarity.
So, why are you still losing? Ouch, right? I know, it's a painful question, but we absolutely have to ask it. You've read all the books, you've memorized the patterns. Heck, you might even have a funded account right now. You're putting in the hours, yet you're bleeding capital. Why? Well, most people at this stage will tell you that your mindset is broken. They'll say you just lack discipline or you have some deep psychological flaw. But I'm here to tell you, they're completely wrong.
The absolute truth is this. The disease is confusion. That emotional instability you feel when you're in a trade, the fear, the rapid heartbeat, the anxiety, that is not your core problem. It's actually just a symptom of a complete lack of clarity. I mean, think about it. When you are entirely clear about what you're doing and exactly why you're doing it, are you anxious? No way. You only panic when you're confused.
Look, you're constantly battling these crazy symptoms, right? The fear, the hesitation, that literal shaking hand on the mouse. But the actual disease? A total lack of clarity brought on by conflicting indicators and wildly complicated rules. When you've got 17 different indicators screaming conflicting things at you on the screen, well, of course you freeze. Clarity is literally the only true cure for trading anxiety.
All right, Section 1, Structure over Indicators. Let's talk about seeing the market for what it actually is. We've got to strip away the noise here and get back to the single most important thing you're probably getting wrong right out of the gate: market direction. First off, markets trend in waves. They breathe in, they breathe out. Simple as that. Second, oscillators and indicators actively distract you from this reality. And third, actual price structure reveals the true direction. I need you to stop obsessing over some oscillator telling you a market is overbought. Listen, a market can stay overbought until your account is completely empty. Start reading the actual structure of the market, because a simple pattern of higher highs and higher lows tells you exactly what you need to know about who is holding the reins.
Now, here's a trap almost all amateurs fall into: the illusion of the ultimate checklist. You kind of think a rigid 20-point rule set is going to protect you from bad trades, don't you? But in reality, all it does is create hesitation and make you miss the move entirely. An experienced professional, though, they use a framework. We're talking dynamic, guiding principles that actually adapt to the changing context and create absolute clarity.
If there is one thing I have learned the hard way over the years, it's this: rules without context are downright dangerous. Markets are alive. They change daily. Volume shifts. Volatility expands and contracts. Participants rotate. This means you simply cannot rely on a rigid checklist without applying the dynamic judgment that only comes from actual screen time and experience.
Moving on to Section 2, Managing Ego and Reality. Here's the truth about your stops and targets.
Okay, the crucial point is how you manage a trade once you're actually in it. Let's talk about ego stops versus reality stops. Be honest, you have that terrible habit of moving your stop to break even the absolute second you see a tiny bit of green profit, don't you? That's an ego stop. It's managed based on your entry price and driven entirely by fear and a need to feel safe. It might feel like discipline, but actually, scratch that. It's really just your ego desperately trying to avoid being wrong. Reality stops, on the other hand, are managed based on market structure. You absolutely must place your stop where the market actively proves your structural thesis wrong, and nowhere else. Think of a market move like a pie divided into 3 slices. Those outer 20% slices, the exact bottom and the exact top, those are pure ego traps. Stop trying to pick tops and bottoms just to feel smart. Professionals know that capturing that massive 60% meat right in the middle of a move is an exceptional trade. Guessing the outer edges will, for sure, eventually destroy your account. Seriously, burn this into your memory right now. Perfection is the enemy of consistency. You have to let go of this desperate need to be the smartest person in the room who perfectly calls the absolute reversal. Embrace the wonderfully boring consistency of simply riding established trends in that middle 60%.
Which brings us to Section 3, the trading trifecta. Spoiler alert, you simply cannot have it all at once.
To build a sustainable framework, you have to accept the uncompromising mechanics of how profitability actually works. It's a balancing act between 3 metrics: risk to reward, strike rate, and trade frequency. Look, if you focus on a massive risk to reward ratio to get big winners, the trade-off is a lower strike rate.
You're going to lose more often. If you demand an 80% win rate, well, you have to accept very small wins and the occasional massive loss. And if you want high trade frequency, lots of action, you significantly amplify your costs, slippage, and execution pressure. You literally cannot maximize all three at once. You have to build a system around your actual personality and your available time.
20%. Listen to me. In the real business world, generating a consistent 20% monthly profit is phenomenal. Investors would line up around the block to fund that. Yet amateur traders view 20% as boring because they treat funded accounts like lottery tickets instead of scaling a legitimate business. Protect the capital, hit the singles, and let compounding do the heavy lifting.
And that leads us nicely into Section 4. Professional execution is boring. It's time to leave the Hollywood drama behind.
If you actually want to survive in this game long-term, you need to completely abandon this romanticized fantasy of intense, adrenaline-fueled yelling at the screen trading. You need a professional routine, and it is intentionally mundane. Step 1. Identify the setup. Step 2. Patiently wait for confirmation. Step 3. Enter with appropriate size and a structural stop. And Step 4. Just let it develop based on market data. That's the whole shebang. There's no drama here, no ego. It's just a simple, repetitive process. I absolutely love this rule. Remember it. Emotion is information, but it is not instruction. Next time a trade goes against you, don't feel shame. Feel curiosity. Assess if the setup was still valid. Remember that the fear you feel in your chest is just physiological discomfort. It's not an automatic instruction from your brain to panic and close the trade. You manage the trade based on structure, not on your heart rate.
So, before you even open your laptop, ask yourself this one question every single morning. Where am I today? Before you look at a single chart, you must assess your own mental direction. A tired, stressed, or frustrated mind is going to take revenge trades and see patterns that simply aren't there. Knowing your own mental direction is just as crucial as knowing the market's direction.
Here's a tough pill to swallow, but a crucial point to accept. The market is completely indifferent to you. It doesn't care about your mortgage, it doesn't care that you had a bad month, and it certainly doesn't care about your desperation. The very moment you truly accept that the market owes you absolutely nothing, you'll stop trying to magically force trades out of thin air, and you'll start humbly adapting to what's actually happening. Make this your absolute new mantra starting today. Stop adding more, start removing. You need fewer indicators, fewer rules, and way simpler charts. To fix your trading, you don't need to go buy another complex indicator or add a 21st rule to your checklist. You just need to remove the noise so you can finally have the clarity to hear what the market is actually whispering to you. Which leaves us with one final choice, really. Are you going to choose the boring, repetitive craft of consistency, or are you going to keep chasing the jackpot? When you finally build a simple framework that you truly believe in, trading stops being this brutal, emotional war and actually becomes a refined craft. But it takes patience, discipline, and total clarity. So my final question to you is this. Are you finally ready to do the boring work?